Hey everybody, Josh Bennett here with Money Masters, the channel where we help you earn more, keep more, and grow more money. In this video, we're going to be taking a look at Roth conversions and why you should be doing a Roth conversion if you're in the midst of retirement and how it can save you money throughout your retirement. We're going to look at what it is, how it works, and everything in between.
So this is how a Roth conversion works. So first, to understand Roth conversion, you have to know that there's really two different types of IRA. There's a traditional IRA, or what's also can be called a rollover IRA, and there's a Roth IRA. How these work is they typically work as shells. So they're not investments themselves, but they are shells that can house different types of investments like cash, stocks, bonds, mutual funds, you name it. Really all the IRA is just a tax shell. And depending on whether it's a regular IRA or a Roth IRA, they're taxed differently. So for example, you're able to contribute up to $6,000 per year into a traditional IRA. That's supposed to be okay. So you can donate $6,000 to an IRA each year. And if you make less than a certain threshold, that counts as a tax deduction. That money then grows tax deferred, meaning you don't pay tax on any compounding or any of the growth until you hit retirement age. And when you hit retirement age, then when you take money out of the IRA, it is taxed. So it's taxed when you take the money out at whatever your tax rate is in retirement. The Roth works a little bit differently. So you can still contribute $6,000 per year into a Roth IRA, but it is taxed when you put the money in. So you put the money in after tax dollars. So the money's already been taxed. And then when you take it out, as long as you meet certain stipulations, which got a little nuance for this video, but as long as you meet certain stipulations, such as like 5-year holding timeframes and things like that, all that money that you take out of a Roth IRA in retirement is tax free. So you put money in after tax, it grows tax deferred when you don't pay tax on that growth. And then when you take the money out, it's tax free. So the Roth IRA is a very powerful tool if used correctly. So what you can also do is what's called a Roth conversion. So now that you understand the difference between a traditional IRA and a Roth IRA, it's important to know that you can actually do what's called a Roth conversion on each year. So some people, one, make too much money to contribute directly to a Roth IRA. And if you make too much money to contribute to a Roth, then you wouldn't be able to make the $6,000 contribution. So, however, you can always make a contribution to a traditional IRA. So the traditional IRA has different thresholds. So, for example, you get a tax deduction up to a certain income limit, but even after that income limit, you can still contribute, get that tax deferred growth, even if you make too much money to get the tax deduction. So it's still a powerful tool either way. But what you can do, whether you have money already in an IRA that you want to get over to Roth, or whether you want to contribute new money that you want to get to Roth, you just make too much money to contribute directly. So what you can do is what's called a Roth conversion. So you can basically take your $6,000 traditional IRA contribution and then convert it over to Roth. So there's a couple steps to this process. So one, you have to contribute to the traditional IRA. And when you contribute to the traditional IRA, if you immediately go from the traditional IRA just straight over to the Roth and don't even stop or near at the IRA, then the IRS will look at that and say, hey, you didn't really intend to contribute to the IRA. This is just a Roth contribution in disguise. And then they'll say that's disallowed and you'll owe taxes and it'll be a mess. So what you have to do is what's called the step doctrine. So you have to basically contribute your $6,000 to the IRA. You have to let it sit in here for a little while. Common recommendation is a year, and then invest it. Then from there, what you can do is you can convert that over to Roth. And so, you may be thinking, well, I could lose money in that IRA. I could gain money in that IRA. Does that affect the Roth conversion? The answer is no. So you can convert as much as you want in a given year. However, you're only limited on new contributions of $6,000 each year. So you can only contribute new money to an IRA or Roth each year of $6,000, which does increase from year to year, but for now it's $6,000. However, for conversions, you are not limited on amounts whatsoever. So you can convert as much as you want. The stipulation with conversions is that if you had a tax deduction on the money that went into the IRA, then that money will become taxable when you convert. And any growth will become taxable when you convert. However, if you made a non-deductible contribution, that money is not taxable when you convert, but any of the growth would be. So, for example, if you're converting over $10,000 that's taxable and your tax rate is 25%, you would owe $2,500 in taxes. So you do have to have that money and take that into account when you do that Roth conversion. So again, you can put money into an IRA and then convert it over to Roth. There's no limits on the conversion piece. So there's no limits between these pieces, but there are limits in terms of new contributions into the IRA and Roth IRA. So now let's say you're the typical retiree and you're wanting to do a Roth conversion. Well, let's say that you, like the typical retiree, have a 401k, and the majority of retirees or peer retirees use 401ks or a similar saving device, whether it's 403b, 457. Basically, an employer-sponsored tax-deferred account is kind of the traditional way that we've had over the past couple decades for saving for retirement. So say the majority of your life savings is in a 401k. So you have $1 million sitting in this 401k. Well, when that money is taken out, as we went over, that is going to be taxed. So that money is taxed as it comes out. And one thing to consider is when you retire at 65, let's say, well, you're going to need income from this. So let's say it starts with 50,000. Well, as you go through retirement, the dollar figures are going to, just because of inflation, you're going to need to take more and more out each year. So which means your tax bill is going to go up more and more each year. But also this portfolio is going to grow. And so as it grows, you're again going to have to take more and more out each year. So then one other thing that kind of complicates matters as well is when you're at the age 72, you have to do what's called a required minimum distribution, or RMD. So required minimum distribution means that you have to take a certain amount of money out of this portfolio each year, and that rate is determined by the IRS. So, for example, the IRS's goal is to make sure that by the time you, for lack of a better term, kick the bucket, that you have this entire portfolio is empty. So they want $0 in here when you pass away because they want their tax money. So Uncle Sam gave you the benefits of having this 401k and that tax deferred status, but now Uncle Sam wants their money. So what they do is they have what are called like morbidity tables to determine when are you going to kick the bucket, and that's the amount, that's the time frame they want to have that empty. So they have a multiplier that says, okay, say we expect you to kick the bucket at 85. Well, we want this empty by 85. So we have a multiplier that says, all right, this is what we need to take out each year to get you down to 0 at 85. So for example, let's just using simple math, this is not going to be an accurate multiplier, but let's say they say you need to take out 1/10 of the portfolio each year. So then starting at age 72, you may need to take out $1 million or $100,000 on that $1 million each year. So basically what that's saying is you have now no control over how much money you're having to take out of that 401k. So what that can do is that can cause some serious tax issues because you're going to have your Social Security, you're going to have other assets that are getting taxed, and now they're requiring this on top of it. So that could really kick your tax rate up to levels that you didn't want to, and really just gives you no control. And also helps, or it doesn't help, but also can bleed your assets down quicker. And those are assets that you need to sustain your retirement lifestyle. So there is an alternative, though, with this Roth conversion to have, if nothing else, more control over your retirement situation, or at least also, and with doing this, is to have more control over how you're taxed on your assets, and can save you a lot of money on taxes as you go through retirement. So now let's assume that you are doing a Roth conversion. So most retirees at the age 65 are sort of in a sweet spot because age 65 to 70, your expenses are typically much lower. So you're no longer in your high income earning years. For at least a lot of people, you typically retire around 65, and that's when you no longer are getting your bigger paycheck for your peak earning years. And 70 is a lot of times when people start really taking Social Security. So during 65 to 70, you may only have Social Security, or you may just like be living off cash that you had in the bank, or whatever the case may be. But moral of the story, typically between 65 and 70, people have very minimal taxable income. Not always the case, but this is just a scenario, and that's this typically what you see with retirees. So what you can do during this time frame, and this can really be used anytime during retirement, but this kind of tends to be the sweet spot. But same concept applies across the board. Is say we want to get this entire $1 million over to a Roth IRA, and we want to do it one, so we can protect our assets, have more control over taxation, etc. Well, what you can do in the sweet spot, when you're in a lower tax bracket, you can then strategically move a little bit over each year. So that way you're minimizing your tax bill, but ultimately getting everything into a Roth IRA. So the benefits of a Roth IRA here are that there's no RMD. So you have no RMD. So this does not exist. So you can keep your money in here as long as you want. So it can grow for later in retirement. It can even grow for your heirs after retirement. Or if nothing else, any of the money that you take out of here, as long as you meet certain stipulations, is tax free. So as we mentioned earlier, that's all tax free. So gross tax free, no RMDs, so you have a lot more control over it, as well as it can pass to your heirs. So what you can do then is between these golden years is take that $1 million, and let's say we want to do $200,000 each year. So do $200,000, and we're going to move that over to the Roth IRA in the form of Roth conversion. You do have to pay taxes whenever you convert. So whatever your tax rate is, so let's say $200,000, that's going to look at as like it's $200,000 of income. So whatever your tax rate is, that's where you're going to essentially owe tax on that. So you want to have cash savings, or just kind of be prepared for that, whether you need to do a distribution. But nice thing again is you can control your tax bill. So you can look at the different tax brackets and determine, all right, I'm at the 25% tax bracket. I can convert 150,000 to stay within that tax bracket and not bump to the next tax bracket. Just as an example of how you can do a conversion. So then you would continue converting a certain amount each year till this is zero. And then all that money is now in the IRA. And then again, you have full control over it once it's in that Roth IRA. So that, in a nutshell, is how a Roth conversion works in retirement and how it can minimize some of the taxes for you.